Hello traders, you're welcome to this video and I welcome you back to the Forex Geek channel. In this channel, we break down powerful trading strategies to help you make smarter decisions in the market. So in this video, we are going to be diving into an important comparison, which is the RSI versus the MFI. Okay, two of the most widely used momentum indicators. So should you rely on the RSI, the relative strength index, or does the money flow index, which is the MFI, offer a better edge? By the end of this video, you'll know exactly how to use each indicator and how they can fit into your trading strategy. So stick around, hit that like button, and let us get started. First of all, let us talk about RSI, or the relative strength index. Now, this indicator measures price momentum by comparing the average gains and losses over a set period, typically 14 periods. Now, the result is an oscillator that moves between 0 and 100. If RSI is above 70, the asset is considered overbought, meaning a potential reversal or pullback could be coming. And if the RSI drops below 30, the asset is considered oversold, which could signal a buying opportunity. Now, traders use RSI to identify trend strength, potential reversals, and confirm entry points in a strategy. But here's the catch. RSI is based only on price movement and does not consider volume. Okay, RSI works well in trending markets but can generate false signals in choppy or ranging conditions. So how does MFI compare? Let us find out. Now, this is the MFI, right? The money flow index is similar to the RSI because it moves between 0 and 100, right? And it also uses, the overbought and oversold levels, okay? However, as we can see that the default for the MFI is 80 and 20. Meanwhile, the MFI includes volume in its calculations. Okay, instead of just looking at price movement, MFI factors in price and volume together, making it a more comprehensive indicator for detecting real momentum shifts. If a price move is backed by strong volume, it adds more weight to the signal. An MFI above 70, or rather above 80, okay, an MFI above 80 suggests strong buying pressure, meaning the market could be overbought. An MFI below 20 suggests strong selling pressure, signaling the market could be oversold. Now, because it includes volume, many traders believe that MFI provides stronger and more reliable reversal signals compared to the RSI. But does that mean that MFI is better than the RSI? Let us just break that down. Okay, here's the big question. Which indicator should you use, the RSI or the MFI? Now, you can use RSI when you want a simple momentum indicator to spot overbought and oversold levels. You can also use RSI when you want to trade trending markets where price movement is the main focus. And you can use RSI when you want to combine it with other indicators like moving averages for confirmations. Okay, now in the case of MFI, you can use the MFI when you want volume confirmation to strengthen your buy or sell signals. You can also use MFI when you want to trade assets where volume plays a critical role, all right, such as stocks or Forex. Okay, and also you can use the MFI when you want fewer false signals compared to the RSI alone. But here is a pro tip. You don't have to pick just one, okay? The RSI and the MFI can be used together to filter out weak signals and improve your trade accuracy. Now, if both indicators confirm an overbought or oversold level, that is a much stronger signal. Let's just see if we can find just one or two examples. Okay, that is the reason why it's important to always have confluence. When you have two indicators telling you that it's the same thing, there is a higher chance of your signal playing out compared to if it is just one indicator. Now we can see that the RSI was at the brink of the overbought territory. Same with the MFI, and it started coming down. Both of them were giving you the same sell signal, and as you can see, we can see it right here. We actually had the price drop significantly, right? We can see that the price dropped by over 440 pips. This sell move gave us about 440 pips. Okay, now compare that to when the let's see if we can find a scenario whereby one indicator was giving us a signal and the other indicator did not confirm it. Okay. Okay, look at this. The MFI was in overbought territory coming down, while the RSI was not. In fact, RSI was around midpoint. Now, can you see that in this case, the signal, in as much as the sell eventually continued for a while, but you can see that this looks like a sluggish sell. Can you see? It looks like a consolidation more than a sell trend. In as much as, well, we have a level of decline, but it looks more like a consolidation than, can you see? It seems like a divergent triangle pattern. Okay, so basically it was not a very strong signal. You can see that the MFI was giving us a sell signal, but RSI was around the midpoint. So in this case, the signal was not as strong as when both indicators were giving us the same signal at the same time. So that's just a very quick example, two examples where we had a confluence and where we did not exactly have a confluence. Okay, so basically it is better when you have two indicators telling you the same thing, compared to when it's just one indicator. All right, so there you have it, the RSI versus the MFI. Now you know the key differences and when to use each indicator. Which one do you prefer? Let me know in the comments. And if you found this video helpful, don't forget to smash that like button, subscribe to the channel, and turn on notifications so you never miss another trading breakdown. Thank you for watching, and I'll see you in the next video. Happy trading.